Hello, good morning, everyone. I'm here to talk about Asia credit, specifically Asia high yield credit. So a little bit about myself. I'm the portfolio manager of our Asian high yield bond fund. I've been managing high yield strategies for over 10 years. And of course, when we talk about Asia, there's always a lot of focus on China. So I'm going to cover a lot of China, both from a macro perspective and also from a fundamental perspective today. So what is the opportunity in Asia? One of the reasons is because Asia has most of the world's population, over 50%, 60% of the world's population. And in addition to that, it is one of the fastest growing regions in the world in terms of GDP growth. And besides that, there is very rapid urbanization going on in Asia right now. A lot of the high GDP growth rate is translating into a rapidly growing middle class population, which is going to drive a lot of consumption in Asia. And as you can see from this chart, most of the major Asian economies are growing between 5 to 8% GDP growth rate. Okay, and if you compare that to the developed markets, such as the US and the Euro area, they are growing at about 2% GDP growth rate. So even if you have a bad year in China, you might grow at 5, 6% GDP growth rate. It is still much higher, more than double that of a good year in the US. And that is why there is still a lot of opportunity in Asia credit, despite China expected to go through a slowdown. So China used to be the production facility of the world. Now that has changed over recent years, because the income levels of Chinese citizens, they have grown significantly, and now a lot of the production in China is being consumed in China. Okay. So this is an overview of the macro factors, or the macro statistics of China. For the past, between 2011 to 2016, the average GDP growth rate is 7.7%. So in 2017, it slowed down to 6.9%. And in 2018, we think China is going to slow down to about 6.5%. That is, we think it's perfectly normal, because China has transitioned from a developed economy during this period of time from a developing economy during this period of time to a more developed economy, in recent years. So as a country, becomes more developed, it's natural for the GDP growth rate to slow down. Okay, and for this year, one of the major topics has been the U.S.-China trade war. So if you want to, analyze how much the impact of a trade war is on China, if you look at the statistics, you realize that exports to U.S., although it comprises about 23% of China's total exports, as a percentage of China's GDP, it only comprises 4.2% of China's GDP. So even if you slap a 25% tariff on all Chinese goods, the maximum possible impact on China's GDP will be 1%. So this year, if China is growing 6.5%, you have a minus 1% impact on GDP growth rate. China will still be growing at 5.5%, which is still a very healthy level. So this is the more detailed analysis on the different scenarios of a trade war with the US. So this is if China doesn't retaliate and US implements tariffs on all 517 billion of Chinese exports at a 25% tariff rate. Okay, and China doesn't retaliate, it doesn't slap any tariff on US exports, and it doesn't depreciate its currency, the GDP impact will be minus 1%. Okay. If China does retaliate, they slap a 16.6% tariff rate on all US exports, and they don't implement any stimulus policies, the impact is estimated to be also about minus 0.1%. We think the most likely case will be China will retaliate to a certain extent, maybe about 16.6% tariff on all US exports, okay? but they will implement some policy measures to stimulate the economy, such as tax rate cuts, such as additional government spending, and they will also depreciate the Chinese yuan by about 8%. If you factor all this into consideration, the impact on China's GDP growth rate will be about 0.6%. So if you deduct 0.6% from this year's GDP growth rate of 6.9%, you will get a GDP growth rate of 5.9% for China next year. So that is still a very good GDP growth rate for China. So, looking at these numbers, personally, I think that the impact of trade war on China has been overemphasized. The real impact is not going to be as serious as what a lot of people think it's going to be, although it is still a relatively significant impact. So since the trade war escalated with the US, the Chinese government has implemented a lot of policy changes in the second half of 2018. One is, they start to loosen controls on local government financing. So it allows a lot of local governments to start to build selective infrastructure projects in regions that need those developments. It has started to cut personal income tax rates. One was implemented in October. The next one will be effective in January of next year. This year, China has cut the reserve requirement ratio for banks, 4 times already, and that has released about RMB 2.8 trillion of liquidity into the financial system. They have also allowed foreign companies to own increased stakes in their local joint ventures with local companies, and that has brought in additional equity capital into China. Okay, they have raised the VAT rebate for exporters to cushion the impact of US tariffs, and they have also increased market access for multinational companies to attract more foreign companies to invest in China. So that brings in additional capital. So this is, the expected impact of the tax cuts at the personal income level on Chinese households. So after the first phase of the tax cut, which is effective on the 1st of October, it has already increased the disposable income of middle-class households by about 8% on average. Okay, the second phase will be effective January 2019, and cumulative together with the first phase is going to increase the disposable income of middle-class households by about 10%. So it is very significant stimulus for Chinese households. And if you look at the percentage of middle-income households that don't pay income taxes after the tax rates, after the first phase tax cut, previously it used to be 7.5%. After phase 1, it will be 20% that's not paying taxes. And after phase 2, it's going to be about 58% that doesn't pay taxes. So, you're going to have a lot of impact on the expenditure, the spending power of Chinese households. So whenever we talk about China, there's always a lot of emphasis on Chinese property, okay? And it has always been the case since many years, because it is a very big sector in the Chinese economy. The direct contribution of the Chinese property sector to the Chinese GDP is about 10%, but if we include the indirect contribution to the GDP through construction work, through renovation work, through sales of household items that families would buy if they were to buy a new property, that would increase to about 30%. And that is why whenever there is a slowdown in the Chinese property market, the government always intervenes with policy measures to control the slowdown, to make sure that there is no crisis in the property sector. And in China, the property sector is a very systemically important sector just because it comprises so much of the GDP, and also a lot of household net worth is tied to their property ownership, and also through mortgage loans, the balance sheets of banks are also very linked to the property sector, and that's why the Chinese property sector will always be a very systemically important sector for China. So as you can see from this slide, the inventory of property in China is now quite low actually. It was high in 2011 and in 2014, and that was when the government implemented policies also to slow down the bubble, and then it's led to a correction in the inventory. And now, for both across Tier 1, Tier 2, and Tier 3 cities, the inventory is now very healthy. It's about 10 to 11 months of sales, okay? And if you look from, the gross floor area sold for China property, the growth has slowed down since 2016 because of very strong price growth in 2016. The government has implemented measures to slow down the Chinese property market. And so, the slowdown in growth, it slowed down from 23% in 2016 to 7% in 2017. And in 2018, the year-over-year growth is only 1%. And with these numbers, and then with the inventory numbers for Chinese property, we don't think it's anywhere close to a situation of having a bubble in the Chinese property market. So overall, fundamentals are quite supportive for the Chinese property market. And if you look at the affordability of Chinese property, when you look at both the household balance sheet and also the size of the property market, you can see that there is a lot of savings to continue to support the sales of Chinese property market. Chinese consumers, they have in total about 70 trillion RMB of savings, and annually this savings increased by about 6 to 7 trillion RMB. And the annual sales of the property market is about 10 trillion RMB. So if you think about the need to put down about 20 to 30% of the property price as the down payment for a new property, okay, it's easily this annual increase in the savings is easily enough to afford to sustain this 10 trillion RMB sales rate. So we think the Chinese property market annual sales is very sustainable. And the other thing about China, is that a lot of people always focus on the amount of debt in the Chinese financial system. It is quite high when you look at it in totality. The total debt to GDP is about 260%. Okay, it is about the same level as that of some developed nations such as Japan. Okay, but most of the debt is at the corporate level. Okay. And it is far easier to control issues from leverage when the debt is at the corporate level than it is to control leverage issues at the consumer level. If you remember, during the global financial crisis, the financial crisis in the US was initiated by over leverage at the consumer level, but you're not seeing that in the Chinese economy. The Chinese households are still have very healthy balance sheets, at only 50% of debt to GDP, okay? And the thing about Chinese debt is it's all internal debt, okay? The amount of external debt, which is, the amount of debt that a country owes to entities outside of the country is shown in this chart, and China has very low external debt, okay? Below 10% of its GDP. And if you compare it to most developed economies, it is far lower. In the US, it's 70-80%, and most other developed nations are much higher, at around 100%. And if you look at China's debt from a perspective of net international investment position, so basically it is the netting of the company's debt compared to the amount of debt that other countries owe this country, which is a true reflection of their of their external assets versus internal assets, you'll see that China is also very healthy in this regard. Okay, so China is a net creditor to the rest of the world, which means that most other countries, after netting all external debt, China is a net lender to the world. Okay, most developed countries, they are net borrowers to the world. UK is at about 0%. US is at about -50, -60%. Okay, and most developed countries, are in a much weaker position than China. So what this means is that, although the total debt to GDP in China is quite high, all of it is within the China's financial system. It's like, taking money from the right pocket to the left pocket. So in the event of a big slowdown or a crisis in China, it's very manageable because it's just about about one company in China lending money to another company in China, or one company in China owing the government money. So it's easily resolvable within the Chinese financial system. They don't have to go through debt resolution with the IMF or anything like that. Okay, so this is something very important to note about the Chinese leverage. That the leverage within China is very, very manageable. And when you look at the household balance sheets, although the household balance sheets, the household debt has risen, it's still 50%. And if you look at, where the household leverage compares to the rest of the world, it is still below the average, okay, and it's much lower than a lot of developed nations. At 50%, it is much lower than that of, say, the US, which is at 80%, the UK, which is at 90%. So the balance sheet of households in China is very healthy. And one of the reasons why the household leverage has remained low is because of the very rapid increase in the income levels of Chinese families. Okay, as the economy has developed, there is a trade-up in the kind of work that Chinese citizens are involved in, from more production work to more service-oriented work to more R&D work, and they're getting paid more. And that's why, even though they've taken on more debt, their leverage has stayed very low. So, the challenges that China is facing, there are answers to those challenges. Currently China is having onshore deleveraging. It's not a bad thing because it is initiated by the Chinese government. It is a way for the country to try to lower its leverage ratio in the long term. Okay, and also the strong USD has always been cited as a source of challenge for China. In a way, it's good for the RMB to weaken because it makes the exports more competitive. Okay, it's just that the RMB shouldn't weaken by too much too fast, otherwise it will trigger a capital flight from the country. And because China has so much FX reserves, they have about 3.1 trillion of FX reserves, they easily have enough resources to control, to manage the slow depreciation of the RMB. So we don't think there will be a big correction in the RMB. The devaluation of the RMB against the USD will happen on a very gradual basis, and it will happen in a way that will serve the interests of China. Okay. And the Chinese trade war, the US-China trade war, we have already covered earlier, and rising default rates. This is natural. The default rate in China is very low. It's below 0.5%. It is artificially low, so it's good for the default rate to actually increase because it will price the cost of funding more realistically in China, and it will stop zombie companies from being able to roll over their debt because credit is being priced correctly. So now I will touch a little bit on the Asia high yield debt market. So what I'm going to talk about is all the hard currency Asia, the USD denominated bonds. So for this market, the market has grown significantly, and right now it is at about $900 billion market, including both the investment grade and the high yield market. It is bigger than the US high yield market, which is at 760 billion, and the European high yield market, which is at 320 billion. So, now at this size, it is a very important asset class in fixed income globally, and it's an asset class that most investors should think about seriously if you are looking to have a diversified portfolio of investments. So this is the makeup of the Asia credit market. As expected, most of it is China, because China is just such a big proportion of Asia's economy. And the other key countries are Korea, Indonesia, India, Hong Kong. And this chart shows the net issuance of Asia credit over the years. As you have seen, it has grown significantly in recent years because Asian companies have only been getting bigger and bigger. So even if that stays at a certain percentage of the company's total capital, the amount of issuance that you're seeing coming out of Asia is going to keep increasing just because the Asian companies are getting bigger and bigger. And specifically focusing on the hard currency Asian high yield market. Okay. Also, the size has also increased significantly over the years. Right now, it's at about 150 billion USD. Okay, in terms of market ratings, it's evenly split between double B, single B, and not rated. Although the amount of not rated debt is quite high, artificially, most of this not rated debt is actually situations whereby the bond issue is not rated, but the issuer is rated. And the reason the bond issue is not rated is because a lot of this debt is very short-term debt. So even though the issuer is rated, the bond is not rated. It also includes convertible bonds and perpetual bonds. So real estate comprises a major component, a major percentage of the sector exposure in Asia. And most of this is China property. Okay. One of the reasons why real estate is such a big component of Asia credit is because of the need to trade up in terms of moving from rural areas to urban areas. People need to relocate. They need to buy new property. People have the citizens. They have growing disposable income. The standards of living is rising. So real estate is one of the main items that households are buying in Asia, and that's why it's such a big component of the index. So I think the general thought is, or the general perspective is that the default rate in Asia must be quite high because it's comprised mostly of emerging market type economies. But in actual fact, if you look at the statistics, even from prior to the global financial crisis, default rates are the lowest among all asset classes, even if you compare it to the US. During the global financial crisis, the Asia default rate was 9%, the US was 10%. On average, over the past 13 years, the average default rate in Asia is 1.7%, and in the US is 2.4%. And it's also much lower than all other emerging market regions. So one of the things that has changed in Asia is, the increasing amount of local investors that are owners or holders of Asian bonds. So as Asian consumers and high net worth individuals have grown more and more wealthy over the years due to the fast GDP growth rate, due to the IPOs of companies, they have started to become a more and more important investor class in Asia credit. And what that means is that we have seen a lot less volatility in recent years during global market risk-offs. So Asia credit now is a much more low beta asset class than say 5-10 years ago. So although the spreads have widened out recently, in recent years, the fundamentals of Asia credit has improved. The net leverage was 4.7 times in 2016. Now it has declined to 3.6 times in 2018. Interest coverage has increased from 2.6 times to 3.7 times. And EBITDA margins have increased from 17% to 26%. So although spreads have widened out, okay, significantly to levels not seen since 2015, it is not because fundamentals are deteriorating. It's because, you know, of headlines on geopolitical news, on Chinese, on the U.S.-China trade war, you know, and on you know, China deleveraging. But fundamentals have improved, and that's why we see, you know, a very good opportunity in Asia credit right now. You know, you're getting more yield at shorter duration compared to U.S. This is double B, and this is single B. Shorter duration and much more yield. And if you look at historical returns in Asia credit, whenever you had a negative year, the next year, you know, the asset class always rebounds strongly and much more than, you know, the correction in the previous year. So if you look across returns in the past 10 years, there's only been 2 years where Asia credit has returned a negative return. And in the next year, the returns have always been much more positive than the write-downs in the prior year. And this year, we are seeing a correction in Asia high yield. So, you know, given the improved fundamentals, we think that next year is positioned to be a relatively strong year for Asia high yield. So in summary, you know, we think Asia high yield as an asset class is very attractive, given the fundamentals, you know, given the macro outlook, and given the valuations. And given that, you know, Asia high yield is such a big asset class, you know, when compared to the rest of the credit markets these days, you know, we think that it's a asset class that you need to seriously consider going forward. So with that, I'll end my presentation on Asia credit, and I'll hand it over to my colleague.